You're about to take out a $20,000 personal loan. You think you found the best personal loan for you. You get approved, you're feeling good, and then they ask you one sneaky little question. What loan term do you want? And most people go, whichever one has the lowest payment, which makes sense. Lower payment feels safer. But here's the catch. The loan term you choose can either save you thousands of dollars in interest or free up hundreds of dollars a month. Same loan, same debt, totally different experience. So today, I'm going to show you how to choose the best personal loan term length using these three glasses right here. 2 years, 3 years, 5 years. Picking a loan term isn't just about math. It's about your actual life. I'm Alex, and I've partnered with Achieve Personal Loans. They have helped thousands of people consolidate high interest debt into one manageable payment. And they treat you like a real human being, not just a row in a spreadsheet. Let's get into it. Okay, visual time. Red water is your principal, the actual $20,000 that you borrowed. Blue water is interest, the cost of borrowing the money. Every glass gets the same red because every term pays back the same $20,000. That part doesn't change. What changes is how much blue shows up. 2-year term, approximate APR of 12.06%. Higher monthly payment around $942 a month. About $2,608 in total interest. This is the let's rip the Band-Aid off option. Aggressive? Yes. Efficient? Very. Emotionally? Kind of inspiring. 3-year term? Same. 12.06% APR. Around $664 a month. Total interest is about $3,934. This is the middle child of loan terms. Overlooked, practical, and quietly carrying the family group chat. 5-year term? Same. 12.06% APR. Lowest monthly payment around $445 a month. But total interest is about $6,730. Same red, more blue. Not bad, not wrong, just a trade-off. That's the key. All three can be smart. The question is which glass fits your life right now. Before you choose, 3 things to check. Number 1, prepayment penalties. Some lenders charge you for paying off your loan early, which feels like getting a fee for doing your homework too fast. So if you plan to pay extra when you can, make sure your loan allows for that. Number 2, income stability. Don't build your budget around your best case month. Build it around real life. If a job change, new baby, move, or big expenses coming, leave yourself some room. Number 3, refinancing. Your first term may not be your forever term. If your credit improves or rate change, you may be able to revisit your options later. So pick what works for you now, then stay informed. Here's the big takeaway. The red is the same in every glass. You're managing the same debt, but the blue changes based on the term you choose. Shorter term, higher payment, less interest. Longer term, lower payment, more breathing room. Middle term, balance. Don't just pick the lowest monthly payment and hope for the best. Compare your options, check the terms, read the details. Then, choose the personal loan term that gives you the clearest path forward. Head to achieve.com to check your rate with a soft pull and no impact to your credit score. And remember, all 3 glasses can work. You just have to pick the one that fits your life. Subscribe for more breakdowns like these.